First, welcome to the video. Today we will clarify what high-yield savings accounts are, why they pay more than traditional savings accounts, and how to use them strategically for your short-term cash, especially your emergency fund. We will also cover trade-offs like access delays, variable interest rates, taxes on interests, and essential safety checks such as FDIC insurance. Finally, we will finish with a step-by-step checklist, a quick quiz, and a concise summary so you can take action with confidence. Next, here is our agenda. We will define high-yield savings accounts, explain why they pay more, discuss the access trade-off and transfer timelines, show how to choose the right account, review taxes and safety considerations, test your knowledge with a short quiz, and wrap up with a clear action plan. Now, let's define high-yield savings accounts. A high-yield savings account is a standard savings account offered primarily by online-first banks that deliver substantially higher interest rates than traditional banks. Typical rates range roughly from 3 to 5%, compared to the tiny fractions offered by many brick-and-mortar institutions. These accounts are ideal for short-term cash that you do not need to access immediately, such as your emergency fund. However, because they are largely digital, instant cash withdrawal at a branch is usually not available, and transfers back to your checking account can take 1 to 3 business days. Always verify FDIC insurance coverage for safety. Moving on, the reason high-yield savings accounts can pay more is simple. Online banks operate with lower overhead because they do not maintain extensive branch networks. With fewer physical costs, they can pass savings to customers in the form of higher interest rates. Competitive pressure among online banks further pushes rates higher. For practical use, these accounts are best for your emergency fund, generally 3 to 6 months of essential expenses, and other short-term goals where preservation of capital and modest yield are priorities. When the account is FDIC insured and you remain within insurance limits, the risk of loss from bank failure is minimized. Additionally, this pie chart illustrates a practical way to split your emergency fund. The example suggests placing 80% in a high-yield savings account to earn a higher rate while keeping funds relatively accessible. It also allocates 15% to a checking account for immediate, same-day access and 5% as physical cash for rare but urgent scenarios like system outages or disasters. Your exact percentages may differ, but this structure balances yield with layers of accessibility. Next, let's highlight the access trade-off. Because most high-yield savings providers are digital, you typically cannot walk into a branch to withdraw cash immediately. Transfers back to your main checking account usually take 1 to 3 business days, excluding weekends or bank holidays in many cases. Consequently, you should plan ahead for bill due dates and large purchases, maintaining a buffer in checking so you are never forced to rush a transfer. ATM access may be limited or not provided at all depending on the institution. Setting calendar reminders or alerts to initiate transfers early can help you avoid fees or missed payments. Meanwhile, this timeline shows a typical transfer window from a high-yield savings account to a checking account. If you initiate a transfer on day 0 in the morning, the funds are commonly in transit on day 1 and available by the afternoon of day 2. However, if you begin the transfer on a Friday evening or during a holiday, final availability may be pushed to the next business day. The key takeaway is to initiate transfers early enough that delays do not affect your obligations. Now let's compare high-yield savings with traditional savings accounts. High-yield accounts tend to offer rates in the 3 to 5% range, but access can be slower because service is online first, and transfers often take 1 to 3 business days. Traditional savings accounts at your primary bank may offer very low interest rates, but can provide immediate or same-day transfers within the same institution, and branch access for in-person needs. Both can be FDIC insured if offered by insured institutions. Therefore, many people keep daily cash flow in checking and minimal savings at their primary bank for convenience, while placing the bulk of their emergency fund in a high-yield account for better returns. Furthermore, before opening an account, review this checklist. Confirm FDIC insurance and keep total deposits within the coverage limits. Compare APY among reputable institutions, avoiding teaser rates that drop quickly. Understand transfer speed so you can plan ahead. Check for any daily or monthly transfer limits to prevent surprises. Ensure fees are minimal or non-existent to preserve your yield. Verify that linking to your primary checking account is straightforward. Lastly, evaluate the user experience of the app or website and the availability of customer support, as these affect day-to-day convenience. Next, Here is a simple 5-step process. First, define your goal, such as building a 3 to 6 month emergency fund or saving for a near-term expense. Second, confirm FDIC insurance and confirm that your total deposits will remain within insured limits. Third, compare APYs among reputable online banks and credit unions. Fourth, read the fine print on transfer speeds, any daily or monthly transfer limits, and potential fees. Fifth, open the account, link your primary checking account, enable two-factor authentication, automate contributions each payday, and monitor the account periodically to ensure the APY remains competitive. In addition, remember that high-yield savings rates are variable. They move with broader market conditions and central bank policy, which means today's rate may rise or fall in the future. Do not feel compelled to switch institutions for every small rate change, since administrative friction can outweigh minor gains. Instead, reassess every few months to confirm your APY remains reasonably competitive. Focus on your net yield after accounting for any fees and the effort involved in moving funds. Moreover, all interest you earn on savings accounts is typically taxable income. In the United States, your bank will issue a 1099 INT form if you meet the reporting threshold. A simple mental estimate of after-tax return is the stated APY multiplied by 1 minus your marginal tax rate. Because interest is taxed at ordinary income rates in many cases, high-yield savings are most efficient for short-term cash rather than long-term investing. Keep accurate records and download tax forms as soon as they are available. Now, a quick knowledge check. Question: which statement best describes the main trade-off of using a high-yield savings account for your emergency fund? Option A: you earn lower interest but gain instant cash access. Option B: you earn higher interest but transfers back to checking take 1 to 3 business days. Option C: you lose FDIC protection in exchange for higher rates. Option D: you can only withdraw on weekends. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. High-yield savings accounts typically offer significantly higher interest, but they do not generally provide instant access to cash. Transfers to your checking account usually take 1 to 3 business days, so planning is important. Next question: which of the following is true about high-yield savings account interest rates? Option A: they are fixed for the life of the account. Option B: they are variable and can fluctuate with market rates. Option C: they are guaranteed by the FDIC. Option D: they are tax-free income. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. High-yield savings account interest rates are variable and can change as market conditions and central bank policies evolve. The FDIC does not guarantee a specific rate, and interest is generally taxable as ordinary income. Moving forward, keep it simple. Choose a reputable, FDIC-insured high-yield savings account with a competitive rate. Automate contributions from your checking account, and revisit rates every few months. Only switch providers if the improvement is meaningful after considering any transfer delays and administrative effort. The overarching goal is to maximize yield on cash that you do not need immediately. Before we close, a brief disclaimer. This video is for educational purposes only and does not constitute financial, tax, or legal advice. Interest rates are variable and may change at any time. Transfer speeds, cutoff times, and limits can vary among institutions and account types. Tax rules differ by jurisdiction, so consult a qualified professional for guidance on your situation. Always verify FDIC insurance coverage and read the fine print before opening any account. To recap, high-yield savings accounts often pay 3 to 5% annual percentage yield, making them a strong home for emergency funds and other short-term cash. The main trade-off is that access typically requires 1 to 3 business days for transfers. Always confirm FDIC insurance, understand transfer limits, and expect interest rates to vary over time. Finally, remember that interest is taxable income, so keep proper records. Finally, here are your next steps. Choose a reputable, FDIC-insured, high-yield savings account and link it to your primary checking. Automate transfers each payday until you reach 3 to 6 months of essential expenses. Remember to plan for 1 to 3 business day transfers when you need funds. Review your APY every few months and switch only if the difference is meaningful after considering effort and timing. As we wrap up, thank you for watching. If you found this useful, please like the video, share it with a friend who is building an emergency fund, and subscribe for more practical money tips. Share your questions and experience with high-yield savings accounts in the comments so others can learn from your approach.